Greetings. Hope all is well with you and your family. As your financial planner, I want to thank everyone first off for your continued patience and understanding. This year, we've seen one of the worst months in stock market history, as well as one of the best quarters in the last 20 years. So to say the market is a bit unpredictable right now is an understatement. And if you've been following my market updates, you likely have discerned that we as a firm have been very much concerned about the market's reaction to rising COVID cases as the economy reopens and its overall impact in our global economy. And as times of market uncertainty, we think back to the tech bubble of 2000, the debt crisis of 2008, strategists, financial experts online, television, they're expressing widely differing views. One extreme, we have some predicting heavy market pullbacks, the other extreme, large gains by the end of the year. See, all of this adds to the uncertainty for you investors and what to do next. But instead of focusing this market update on the reasons why we as a firm are being cautious, this update, I wanted to focus on the divergence in stock market categories that we've seen this year and why these may be opportunities going forward. You notice in our illustration here that of unemployment rates. Historic unemployment rates, as we see, have hovered somewhere between on average 4 to 8%, with some outliers on each of those. However, we've seen that current unemployment rates, though, have come down from well into the teens to currently a little over 11%. This matches that of a recent recession in 1982, where unemployment rates reached higher than 10%. Now, recessions typically will affect small businesses more than well-capitalized larger businesses that may have greater access to cheap capital. So we've heard the headlines then that the stock market has rebounded off lows, and for many, they're at or even above for year-to-date numbers. Well, yes, this is true in such indexes like our tech and growth-heavy NASDAQ, the large core-focused Dow and S&P 500. We see that doesn't really tell the whole story of how the market is doing. We notice that value-based stocks, which typically pay dividends, shaded there in red on the left, are still down year-to-date. Not to mention one particular sector that's been especially beaten up, small cap value stocks. Some name brand small cap value stocks that you might recognize are that of Abercrombie and Fitch, Franklin Templeton Investments, or for you campers, Yeti. Now, with regards to small caps, historically we're paid for the risk. Greater risk, they're more sensitive to economic conditions. But over the last 20 years, we see small cap value has outperformed the last 20 years, the S&P 500. As mentioned, that small cap companies are more sensitive to market downturns and recessions. And we see here in a recent one in 2009, that was very similar. During that last recession, small caps underperformed their large cap counterparts. However, after that recession, during the recovery phase, we see how they outperformed their large cap counterparts. So the point is, we see that there's still plenty of possible growth in portfolios, even if large caps seem to have rebounded maybe out of just sheer enthusiasm and expectation. So we can anticipate in time that small and mid caps, this and other investments, the risk return will be of value, and we can capitalize on future growth. So no need to feel as though that perhaps we've missed the boat in the last few weeks. But in the meantime, there continues to just be too much risk on the table, and we're encouraging a defensive position in portfolios. We're monitoring it daily in hopes to capitalize on these and other future opportunities in the portfolio. So in the meantime, we want to thank everyone once again for your patience and your support. here at Baumgren Retire Plan. And as always, if you'd like to speak with me one-on-one, please email me or use the appointment booking feature in my email. So be safe, and we hope to once again see you soon.